Today we're going to talk about exits because nothing you ever do when it comes to trading will have a greater impact on whether you become wildly successful or wildly broke than your ability to exit your trades on time. I mean, this is everything. It's what separates the amateurs from the pros. But unfortunately, too many traders will spend way too much time thinking about when they should enter a trade, giving little to no thought on when they should exit the trade. And just think of it this way. Doesn't it seem absolutely ridiculous to spend all of this time relentlessly studying these entry techniques like chart setups, candlestick theories, and indicators if all you're going to do at the end is sabotage the quality of that trade over a terrible exit? I mean, ask yourself, how many times have you been in the right trade at the right time only to give up on it way too soon? And there you sit counting this imaginary money in your head that you could have made if you just would have stayed in there a little bit longer. Or how many losers have you taken only to realize if you would have been a tiny bit more patient, that would have been a big winner? Now, if this is your problem, your exit strategy isn't where it needs to be. And right now, that might be the only thing holding you back from being great. By the way, my name is Doug, and I've been a trader now for more than 25 years. And today I'm going to give you my entire exiting strategy. The same exit strategy that I've been using for almost 2 decades to help me consistently take 6-figure-a-month profits out of the market. I am going to give you everything that you need to start exiting your trades like you are a true professional. No fluff, no BS, just a 20-year track record of proven success to help you get to max profitability starting now. Now, before I break down my exit strategy framework to help get me to $100,000 a month in profits, I have got to show you on the charts the critical mistakes that I was making almost every single day of the week when I started. And I got to show you this because at the time, I had no idea that the reason I was losing so much money was because of my exits. I thought it was because of my entries. I thought maybe my strategy wasn't good enough. I wasn't using the right indicators or enough indicators, or maybe I was just trading the wrong stocks. I don't know. But I thought my problems were entries, not exits. When it turns out the reason I was losing so much money is because I had little to no exit strategy whatsoever. So let me show you here on the charts what was happening to me over and over again that was costing me tons and tons of money, starting with what a losing trade for me would look like. So right here on the screen was one of the patterns I used to love to trade, the ascending wedge or rising wedge, whatever you want to call it. I no longer trade this thing, but I would look at it and say, man, you got all these higher lows. This thing is just kind of grinding up. If it can just pop the top of this range, this thing's just going to go parabolic. It's going to go straight to the moon, and I'm just going to get rich. This trading thing's going to be so fantastic. So what I would do is I would enter that trade on the break of that range. My entry or my buy order would be about right there. And sometimes I would use the trend line as a stop loss, maybe right here. Or if it wasn't too far away and the risk wasn't too high, I would put my stop at the low of day. That's where I kind of preferred to put it. But it didn't seem to matter where I put the stop because shortly thereafter, or maybe an hour later, the market would just grind down and hit my stop no matter where it was, whether it was under the trend line, whether it was maybe located in this area or way down here. It just found a way to get to my stop and take me out. Now, stop losses are just part of the game. We all have to go through that. We need to have risk management. But at about 60% of the time, this is what ended up happening. Like 60% of the times I took a loss, it was a mistake, and the thing just kept on grinding up for the remainder of the day nonstop, and I was just losing money or just counting the money I could have made. Now, when it came to the winning trades that I had, I would see a nice little setup like this that might be a flag. I used to like those flag patterns, and I would do like the break and retest or the pullback after the breakout because I had traded so many breakouts and lost so much, I decided to let them pull back and trade it that way, which in some cases it worked. So I would see a chart like this and say, you know, you got a lot of support here. It's been grinding up. It's holding. The market wants to kind of run this thing right back up here to the moon. And again, I'm going to get rich doing this trading thing. It's going to be awesome. And sometimes, like I said, they'd work. You would get this really, really nice candle. But then I would see this thing and start talking myself out of the trade. I'd start becoming a pessimist thinking the market's going to find a way to take this money from me because I had lost so many times and so much money. I couldn't help but be negative. So I'd start to panic and I'd think, oh, they're going to sell this thing at resistance, or they're going to find a way, or some news is going to come out and it's going to ruin this whole trade. And I would panic out and just take the money because sometimes, honestly, I just wanted to be called a winner. I had lost so much. I just wanted to know what it felt like to have a winning trade, even if it was like $10. And of course, Again, most situations, what happened was I was leaving tons on the table. It would just rip, and there I was again at the right place at the right time, sabotaging yet again another quality opportunity. And at this point, I would realize that, look, unless the thing goes straight vertical and goes huge, I'm not going to make any money. Like if I stay in it for any length of time, I'll find a way to sabotage myself out of the trade. And another example would be something like this. I would go right back into another flag type of pattern, same kind of analysis. I'd say, wow, you got all of this rising support. This thing is pulled back nicely. It's going to make another flag and just kind of continue to go up for eternity. Again, I'm going to get really rich trading, but then about an hour later, half of these trades that I took did this. They didn't do anything at all. Now you might be thinking at this point, well, at least you weren't losing any money, man. You got to be happy about that. That's very true. I wasn't. But what was hurting me here was opportunity cost. There were other things that were running, but I was sitting here fixating on this thing, burning all of this mental capital when I could have been trading something that was moving. And it just seemed like over and over again, one of those three trades would play out. I would either get stopped continually on trades that would have worked. Every time I did have a good winner in my hand, I would find some way to just ruin it over and over again. Or half of the time, I just ended up in garbage. Garbage that wasn't going to move, that didn't have any volume, that couldn't go anywhere else. So let's start talking about this framework on how we're going to fix these problems, or how I fixed it and what I did to turn around. Let's take a look at step one, which is something called expected value. Before you ever enter a trade, you have got to know whether or not this thing has enough stamina to deliver you the target that you came for in the first place. For example, we're often taught when we start to look for a 2-to-1 or 3-to-1 risk versus reward. Some traders use things like Fibonacci retracements or Fibonacci extensions to figure out where their targets are. But if you're like me, most of the trades I took never got anywhere close to their target. And the reason is because I didn't understand the expected value. So the easiest way for us to determine the expected value is through two things. We want to use daily chart range, and then we want to use something that I call wave range. And I'll show you the difference between the two and why we need them. Starting with the daily range, we have to know first and foremost that what we're about ready to trade does in fact have the value we need to get paid. The easiest way to figure that out is through something called the ATR, Average True Range Indicator. It's the quickest and easiest way. It will measure what is the value of an instrument you're trading. So for example, I have the SPY. This is the S&P 500 ETF, and I have the daily chart. That's where we want to begin with the daily chart. Now, if you look down here, you'll see it tells me that the daily movement that we are getting on a day-to-day basis right now in the SPY is $9.50. So if I'm scalping or day trading, that itself, $9.50, is enough for me to get whatever it is I want. If I'm trading for $2, $3 a share in gains, or 3-to-1, 4-to-1, there's enough there for me to get whatever I want, no matter what side I choose to trade on. But that itself isn't going to do me enough good if I can't figure out something called the wave range, which is very easy to do. Now, one of the things I really try to do the most when I trade is focus on rhythmic sequences. So this is what I would call wave range. Sometimes in the past, I've referred to this as a measured move, but here's what it is. Let's focus on the actual rhythmic moves in one continual sequence. This will mark our range. So for example, let's take the very base of this rally right here in the SPY that was started at like 562, right? $562, and it moves straight up. Now, there was a tiny little red candle in there, but for the most part, this was an unabated straight up move that tops out at about 565, right? So you've got roughly $4 in that move continual, okay? Now, if we go back to that daily chart range, it was $9.50. So in that burst of upward momentum, we chewed in to roughly 50% of that daily range. And I'll show you why that's important. Now, if we take a look at the subsequent retracement comes back, it moves from 565 down to almost, not quite 563. So you have about a $2 pullback, right? Followed again by close to another $4 rally. And here we are reversing that sequence and now moving down. Now, kind of off topic here real quick, not off topic, something very important to you. You're going to notice everything you trade moves in some rhythmic sequence like this. Now, here's why this wave range is important. If I am a buyer down here at the very low point of that chart, and again, this is not an entry video, but if you say entry is there, you can expect to get a 3 to 4 to 1, or you can expect to get what? $4 worth of waved range. It's not outrageous or unheard of, or it's not that you're being too greedy. That is a fair value for your positioning on the trade. Now, here's why, or here's how this really pays the dividends. If you're scalping and you're choosing to enter up here, right? Again, this is not about entries, it's about exits. But if that's your choice and you're scalping it, it would be not advisable in most situations. Again, we're talking about most situations as well. It would be unadvisable for you to go up in here and expect $4 to $5 more without a pullback, right? You would want to wait for a pullback, or maybe you would want to think about shorting it. Again, I keep saying this is not an entry video, but that's what you would want to look for. And then if you buy down here, like maybe the flag pattern break and retest, then you would in fact look for another $4. And you'll see that that's pretty consistent in this entire movement, because once you've moved up here, it's not that this is a bullish or bearish instrument. So I try to refrain from using those words, but it's not bullish versus bearishness. It's wave versus wave, move versus counter move. So you'll see that after the $4, it's really tough to expect any more out of your exits. So depending on that entry you have, and depending on what's available in the daily range, because we still have, right now the SPY is up, if you look at the top, about $4. So we still have a potential of $3, maybe even $5 more in the tank if it wants to give it to us. But it's not going to give it to us all in one clean move. Hopefully that makes sense. So we really want to kind of measure those moves and look at those moves, because that sets the expected value, right? If we're going to chase a little bit, or we're scalping after 3, 4, or 5 bars, I'm not here to tell you whether that's a good idea or not. But if you are, at least you know what you're getting yourself into, right? That's all that's important, that you know where you stand when you push the button. What is that expected value that you're going to get out of the trade? And what we're going to do, again, we're looking at that range on the daily. We have plenty of that. But more importantly, that waved range. Measure each one of those moves in its sequence, and that'll really give you a good idea on what you can expect, right? So let's move on. We're going to move on to step number 2. And this is, we have to make sure that the market does not screw us out of this winning opportunity. Again, this was a killer for me. I cannot tell you how many winning trades, game-changing winning trades, I let slip through my fingers because I took my gains way too soon. Now, a good tactic for this is something called reverse charting, and it's very simple. It's exactly as it's spoken. We want to take all the chart patterns that we know, that we learn, that we do trade, and just kind of cut and paste them and move it over to the right side of the chart. Now, this was huge for me, was visualization, drawing out what is it I expected. And I'll tell you why this is so important, because what I realized is that, like I said earlier, unless the trade worked out immediately, like when I bought something, if it went up, it had to go up in seconds. Otherwise, I freaked out. I sabotaged the trade. And I realized that about 80% of the trades you take, they don't work right away. They actually take a bit of effort. Isn't that what it is? Like if you take 10 trades, I'd say maybe 1 or 2 of them work exactly the way you planned. But the remaining 8 are honestly, they're like a pain in the ass, right? You really have to put in the effort. And those 1 to 2 trades that you make the most out of, they're going to change your entire trading game. So let me show you what I'm talking about here. We'll stick with the SPY. Maybe we'll look at gold here in just a second as well. So take a look at this. We have this one upward thrusting move and now pulling back. Again, I am looking for that pattern to kind of continue to repeat itself. So first and foremost, let's say I purchased this at the very low point of the day. Again, this is just an example. Let's open up this chart so we all can see it. Let's say I'm buying this range break here and none of this chart exists. What I'm looking for is what would that right side of the chart look like if I were to draw a few patterns. So without seeing this, let's say it moves up and maybe I'm looking for a very slow grind and then a ramp up. Or maybe I'm looking for another flag to develop with a slight pullback and then another push up, which is what you actually got. So once you went vertical, you got a slight red right there, followed by another upward thrust. Now, here's why I want to show you what's so important about this and making sure we're all on the same page. If I bought here and I was immediately rewarded with a pretty good move of 563 to 564, that's a good trade, right? I mean, if you put some money in there, you put $100 in, you got a couple $100 within a few minutes. Your intuition is going to want to take that. But for me, what I like to do is think about, well, I know it's not going to go straight up $9. There's going to be a pullback. What's listed, or not listed, but what's the information that I got from that pullback is going to help me determine what may happen next. And you'll see here, in this case, there was a very small red, right? That was immediately retraced again. So I would have given a little bit of room after this to see what that pullback. So you have this intensity move upward, but then what you end up getting is not such intensity to the sell side. They're mismatched, right? And you see that's actually what's happened if we go back and we talk about the range move. You have long side or bull side. I hate to use the word bullish and bearish, but you have long side tendencies because you have $3 up thrusts followed by $2 down thrusts. So your up thrusts are more than your down thrust, which means you have your higher highs, higher lows, your typical intraday strength structure. I would look for that. Same thing here. If I was in, I would still be looking for this to curl back up. Okay, depending if my entry was down here. Now, if it's up here, I don't have that luxury, but at least I am aware of that. Now, for those of you who trade other instruments, if you look at something, let's say, for example, gold. I have the gold futures up here, MGC, just for an example. Let me minimize this. You'll see you have remanufacturing of a pattern. So, for example, once you come out of this range, look what happens. You move upward in all of these flagged formations, right? And as long as that's happening, let's see if we can open that up so it's not so small. You'll see it clearly right there. Once you break that range, you come up, you pull back, you continue to create flags, higher highs, higher lows, higher highs, and higher lows. Now, as long as this is happening, and that is the pattern that you have, you should still stay in the trade. So if we're getting in on technicals, we have to get out also on technicals. And this is kind of one of the struggles we do have with exits in the first place, is that our entries are so calculated and tactical, but then our exits are often emotional, right? So you can see that right here in gold. And eventually, until that structure is broken, there was no need to ever get out of that trade. So let's go ahead and move on. So after we figured that out, we're going to move on to step number 3, which is the multiple of 5. We're going to use this because many of the trades, just like the trades I had taken, are not going to work at all. They're just going to sit there and go sideways. And at some point, you have to cut that and move on to other opportunities. And the best way I found to do that is something called the multiple of 5. Let me show you what that is. Now, the multiple of 5 is pretty easy. We won't have to spend too much time on this one here. This is something I came up with to keep me out of doldrum trades, just dead money, and not burning up that mental capital and wasting opportunity costs. And it's not 100%, but it's a very, very good gauge, and I'll show you what it is. All you have to do is take the time frame you are trading on. So for example, I'm using the 5-minute chart of the SPY. I will take the 5-minute chart, I will multiply it by 5, and this is easy math, and that equals 25. So what this does is tells me that if I enter a trade and I am not seeing a move in my favor, it's just kind of bouncing back. If it doesn't do something within 25 minutes, I should probably get out of the trade. Now, this is not always 100%, and I'll explain. But I want to say this because it doesn't mean that we are incorrect about our ideas. This is something I want to make sure everybody understands. We have our ideas, but the market has to agree with us at that point in time. So what I've found out that if I get into something and it doesn't start working in my favor in 25 minutes, it doesn't mean I'm wrong. It means that my timing is off. And in most cases, most being 70% or more, it's better for me to take the loss or take the small gain and come back and visit that trade whenever it's ready. I don't need to wait necessarily for that to come down to my stop loss and completely take me out. Now, when I say it's not 100%, there are unique times when you might be in something and that 25-minute thing goes off and you're like, well, let me take another look, maybe move the stop, maybe rethink this whole trade. But I really need to stop what I'm doing, focus on that trade, and determine whether or not right here at this point in time, it's worth me staying in the trade. Or is there something else that's moving where I don't have to waste that mental capital? And again, that's really easy. If you're using like a 1-hour chart, that's 5 hours. Your trade should be 5 hours. Not just that, that's usually how long the trade will last anyway. So again, if you come back and you look at this, and I'm using a 5-minute chart, that's 1, 2, 3, 4, 5. That's a 25-minute up run. You come down there, it's a little bit longer than 25 minutes, but it's the same thing. 1, 2, 3, 4, 5, 6. You have roughly 30 minutes to the upside. So you see, it's not just candlesticks and measured moves and price. It's also time. Time is a serious element for what we're doing as a trader. So by doing this, it will help me first stay out of a doldrum trade that isn't working. Once something does start to work, it can help me kind of determine, along with pricing, right? Along with the reverse charting, along with the range, it can help me determine whether or not I should continue to keep this trade or get out of this trade. Now what we're going to do is I'm going to show you a live trade using this exact formula. And we're going to do the whole top-down analysis from determining the range, the wave range, the reverse charting, the measured moves, the multiple of 5. We're going to use all of those factors, and I'm going to show you exactly how it works in a real-time trading environment. That way you'll know for sure whether this is going to help you get to the next level or not. So let's take a look at a potential trade here on Palantir, and we want to do the entire top-down formula, starting with determining what our daily range is. Now, before I do that, you'll see, like a lot of stocks in this market, are in a distribution phase or a downtrending phase. But if we take a little bit closer look here at this Palantir, you'll see it is breaking range here on the daily. Now, at first, we might feel that this is a long trade because it is, in fact, breaking out and breaking range, and there could be a great potential opportunity. But let me show you what we have in the current situation. We'll begin with that ATR. Now, if you look at the ATR, you're going to see that Palantir is worth about $7 to $8 per share a day. And why this now becomes so important is if I take a look right here at the intraday 5-minute chart, you're going to see Palantir is really getting aggressive to the upside. And if I go back to yesterday's close, which is right down here, about 89, and we're currently at 93, you're going to see that we've chewed up a large portion of that range. So we've used half of that range right off the bat. And you'll even see it was just a minute ago at 91. Now, this is not an entry course or entry video, I should say. But if I kind of back it out, you're going to notice that right over here is an area of significant resistance, roughly about this 94. It was also a plateau or a resistance area from the previous day. So for a 2-day span, Palantir has struggled with this 94 level. And we're getting very, very aggressive, and we've chewed up a portion of range. So at this point, because this is in a downtrend overall, right? And we've gotten a little bit too aggressive. What we want to do is take a look at possibly shorting this as soon as we get some sort of slowdown. Again, this is not an entry video. I've done plenty of those, but we're going to try to first focus on getting an entry to the short side. And we're going to try to look at maybe reversing that entire $4 process, getting the most possible gains, because up here, our risk is very low and our reward can be very high. So let's come back to this and see if it gives us a good setup on the entry. So as mentioned, I found the entry signal that I was looking for to feel comfortable about going short or to the sell side of Palantir. Now, this is not an entry video, but I'm pretty comfortable with it because of what? Because of the range. We've consumed about 80% of the range very, very early. You'll see it even got up there towards 93.50. So what I'm banking on here is for this to pull back and go down and move back and retrace a lot of that range. So for a target, we're going to look for somewhere around 91 here, and maybe even 89.50. And we're going to look for that pattern to remanufacture itself backwards. So let's come back in a minute and visit this pattern. Let's jump right back into this Palantir, and you'll see it did not take long for us to get paid here on this trade. Well, we haven't been paid yet. We haven't taken anything. But I wanted to highlight this humongously strong red bar. Take a look at this intensity. It's not uncommon for us to want to sell something like this, or just to cover it because I'm on the other side of the trade. But it's not uncommon to want to grab those gains because, look, they're very nice, right? This is a good day already just with this trade. But there could be a lot more. In this case, what I'm looking for is as long as this thing doesn't snap back with any violence, then it should continue to go lower. It's just getting started. And this is a very delicate area for us as traders because we might get another $1 or $2. And at 1,000 shares, that's a couple of grand. So let's continue to remanufacture some sort of down pattern. So I would look for, I'm not completely scared of a bounce, but we might want to look for something like this and see if we can get a little bit of panic. You'll see, again, the intensity. But take a close look at this candle. You'll notice there isn't any retaliatory measures on it. There's not any retaliation, right? They're not coming in there and scooping this thing back up. They're just kind of letting it fall. We don't want to cover it. We do not want to get out of this trade. This candle, this setup, this whole entire thing, it's just getting started. You can see that, or hopefully you can see that. And this is important because the more we can make, the better our trades. So let's just kind of come back and see where we are here shortly. So now take a look at Palantir. This is the power of really being patient with your exits. And if we take a really close look, right, it's a good thing we didn't cover it because it's given us so much more. Now look, it's flushing, but I'm going to cover this up, but I'll show you what I'm talking about. Never really made any retracement. Like after an intense, strong red bar, notice it didn't really bounce that much, and it's still not bouncing. But now, because we've consumed so much of the range and we're going down $4, right, we're going to try to reverse that. I'm going to take it because I got my target. And usually when you get these pretty aggressive ones, there's going to be some sort of retaliation, roughly around 89.50, maybe right here where it sits. But I'm going to take the profit, and now I'm going to look to reverse manufacture this. I'm actually going to look to maybe buy into this and do the same thing in reverse based off of that range. But again, showing you the power of hanging in there, because the difference of not taking that early to now, it's huge, right? That's several thousands of dollars more. You're already putting in the work. You're already doing the trade. You might as well do your best to get paid. So I wanted to come back to this trade here much later, and I want to show you exactly what I was talking about in the last segment. We're looking to reverse manufacture. So remember I said I would be interested in longing based off of that range extension. Now, for those who follow the channel, you had the beautiful John Wick here. I got in a little bit late over here at 88.09, but the formula was still the same. The origination of wanting to do that came from the extension of the range. Now I want to show you this one because we're long. We're looking at that reverse pattern. So look, as we come up here, you have now flag patterns, break retest kind of patterns, or whatever you want to call them, ascending wedges. You now have a reverse pattern. And as long as this pattern continues to stay intact, we're looking just to reverse everything that we did. So we were looking for, $4 right here to the downside. We're going to look for that range of $4 or maybe even more to the upside. As long as this pattern continues, right, we'd have no reason to get out of it. And that's what this whole video is about. It's about when you're focusing on the exits, giving yourself the data and information you need to become confident to get the most out of it. Because on either one of these trades here, I could have cut them very, very early and just taken a few $100. Now that would be great, but look what it cost me. Look at what holding and just being patient and kind of having these tactics in your toolkit, how they can just make these trades better. And like I said, look, you're doing all the work. You're doing it already. You're putting in the time. You might as well be paid the most that you can, all right? So let's kind of take another review of this. Now let's do a quick review of what we learned today and how we're going to maximize our exits from here on out. Starting with step number 1, we want to make sure we determine the daily chart range by using the ATR. So we'll know exactly whether this trade is worth our time or not. Now, once we've established that, we move on to the part about the wave range. We need to pay attention to that rhythmic pattern. And you'll find out not only will this help you maximize your exits, but it'll help you with your entries too. So it's good for both, and it'll really help us get in the right position most of the time to make the kind of money that we deserve to make when we're trading. Now, after that, we move to step number 2, which is remanufacturing all these patterns that you have learned. The chart patterns that you're using to get in, visualize what it might look like on the way back up or on the way down if you're short. Again, this was huge for me because it allowed me to set that expectation. Because what you're going to find out is most of the trades that we take, at least for me, a good 70 to 80%, do not work out right away. They're quite a bit of a struggle. And like I said earlier in the introduction or earlier in this video, that if it didn't work out right away, I didn't make money. The longer I was in a trade, I found a reason to sabotage myself. I kept second guessing whether or not I was doing the right thing. And that was the killer for me. I just was not patient enough when it came to my exits. And third, we really want to focus on that multiple of 5. It's not an ironclad guarantee, but it's a great benchmark that'll let us know whether our timing is coinciding with the asset we're trading and that market is ready to move up. It will also let us know about our targets. If we are in that trade for 25 to 30 minutes, what does it look like? Is there still more upside room? Does it still match the range? Is the wave range good? And when we combine all of these things together, we're going to be a force to be reckoned with. You're going to start making a lot more money. And like I said, this is seriously important because you're already doing all that donkey work to get in the trade. You might as well make the most out of it, right? So anyway, guys, I hope this video was of help to you. As always, feel free to comment down there in the comment section, anything I left out or anything that you would like for me to talk about maybe in the future or answer your questions. I do want to take this time before I sign off on this video to remind you that every single week we put together a free gains guide. It's a complete view of the market and the very best stocks and assets to trade for the week. We give precise entries and exits, and the best part, it's completely free to everyone. So on that note, let me say thank you very much for watching this video. Take care, trade well, and I'll see you soon. Cheers.